The IRS just announced major tax changes for 2026, and these updates could completely change how much money you actually keep after taxes, new tax brackets, new deductions, and a new capital gains rule that could hit gold and silver investors hard. Let's break this down step by step, so you know exactly what's coming before January 1st, 2026. Welcome to Money Studio, where we explain how money and technology shape your future. First, let's talk about the standard deduction. For 2026, single filers will get to deduct $1,600. Married couples filing jointly can deduct $3,200, and heads of household get $2,450 off their taxable income. If you're 65 or older, there's even more good news. You'll get an extra $1,650 for singles and $2,500 for married couples. Plus, there's an additional $6,000 senior bonus deduction that begins to phase out once your income passes $75,000 as a single filer, or $150,000 as a couple. But remember that extra bonus expires after 2028. Second, let's look at the new tax brackets for 2026. These determine how much of your income is taxed after deductions. For single filers, 10% on the first 12th on a 400, 12% up to 5,400, and 22% up to 105,700. For married couples, the numbers are doubled. 10% up to 24,800, 12% up to $108,800, and 22% up to $211,400. Even a small change here can shift how much you owe, especially if your income has moved into a new bracket. Third, let's talk about capital gains stocks versus gold. This is where things get really interesting. If you sell a stock or investment after holding it for more than 1 year, you qualify for long-term capital gains tax rates. For 2026, those rates are 0% if your gains are under $49,400 as a single filer, 15% up to $545,000, and 20% beyond that. If your adjusted gross income is above $200,000 as a single filer, or $250,000 as a married couple, you'll also pay a 3.8% net investment income tax. But here's the catch. Gold and silver are not treated like stocks. The IRS classifies them as collectibles, meaning they're taxed as ordinary income, but capped at 28%. So even if you hold gold for years, you won't get the same tax break that stock investors enjoy. If gold prices jump and you sell for a profit, you'll be taxed at your marginal income rate, not the lower 15% capital gains rate. That's a big deal for anyone holding precious metals. Fourth, let's talk about why this matters right now. With U.S. debt growing, inflation still running high, and both interest rates and commodity prices moving fast, these IRS changes aren't just numbers. They decide how much of your wealth you actually keep. If you invest in gold, silver, crypto, or stocks, 2026 will be a year where tax efficiency equals higher returns. The winners will be those who plan early, not those who panic in April. So, take a moment to review your portfolio. If you're heavy on collectibles, consider balancing with assets that qualify for lower capital gains rates. Finally, here's the bottom line. The 2026 IRS update isn't meant to scare you, it's a reminder. Tax laws change, but smart investors always adapt before the deadline. Whether you make $40,000 or $400,000, understanding your tax bracket, deductions, and asset types is the fastest way to legally keep more of your money. Watch more insights on Money Studio's main video, The $4 Trillion Time Bomb, How One Island Could Crash the Global Economy. Stay informed. Stay smart. This is Money Studio. Subscribe, like, and turn on the bell for more daily insights on money, tech, and success.